in Kitri as well who wanted to have a basic overview of the financial markets. So as you can see from my screen, I'm just enlarging it. So as you know, there are different types of investments that you can do. And most of you would probably know the type of investments that you can make. Uh, but I'm going to run through that type of investments we can make and tell you what are the key terminologies or key information that you need to look through when you're making your investments. Again, I'm not a qualified investor. I'm only sharing my insights and experience I gained by learning the book Intelligent Investor by Benjamin Graham. So there are different types of investments, as you know: fixed deposits, bonds, gold, stocks, mutual funds, pensions, exchange traded funds, and real estate investment trusted funds. So these are the types of financial market instruments that are provided for the general public to do investments. And there are different types of risks and different types of benefits for each of these investments, and which I'll go through in detail. So in terms of making those investments, the first and fundamental thing that you need to know in UK especially, I probably haven't covered Spain, but it may be the same type of thing for Spain and other countries. But you have a savings ISA where you can save the money and you earn a fixed interest, which is pretty less. For me, it's the dead account. And you have a type of an ISA, which is fund ISA. And there's also an ISA called stock and share ISA. The main difference between a fund ISA and stock and share ISA is as the name suggests, that with a fund ISA, you can only invest in funds. Like for example, Vanguard has got a lot of funds, and you can't invest in any stocks in the type of a fund account. But whereas if you're taking a Hargreaves stock and share account or HSBC stock and share account, you can invest in both stocks and funds, but it will have an annual charge, and you'll also have some charge for each and every trade that you do on that account. So in terms of the government policy, is that any investment that you made on an ISA, any capital gain on the investment that you made on an ISA is tax free. So any capital gain or dividend you earn on amount that you actually invested in stocks and shares is completely tax free, unlike the property market where you have capital gain tax and also rental yield tax. And now with the upper stamp duties and also buy to let property tax rule changes, property market is having a lot of taxation, whereas in here for up to 20,000 per person, whatever investments that you're making, it is absolutely tax free. And there's also an SIPP ISA, which is actually for storing the money for long term investments, like for example 20, 30, 40 years, based on what your age is. It's called systematic investment pension plan ISA. So it has got 40,000 limit, and you can pretty much do what you can do in stocks and share ISA, where you can invest in stocks and all funds and investment trusts and gold ETFs. You can do everything there, but you can't withdraw any amounts before 55. If you withdraw, your tax is the tax that you need to pay is absolutely ridiculous. So, in terms of principles of investments, there's a basic misconception which I also had when I actually started my journey into investment. uh, Learning investment and actually investing intelligently into any of these financial instruments doesn't require a high IQ, but it actually requires someone with high emotional intelligence who believes in long-term evaluation and management principles of a company, rather than what do I call? I don't know how to put this, but your emotional intelligence should be high. That you should be discarding any fluctuation that happens in the market. So basically, what I'm saying is you should ignore Mr. Dodgy market price, who's a bully, who will always impact your emotional intelligence in terms of selling and buying in a short term, which you should not be looking at when you're doing an intelligent investment. It's always long term investment, and it's always systematic investment plan. So I won't dump 20,000 or 30,000 pounds into something in one single day. Um, and then sell it in the next couple of days if I made a reasonable profit. And that is not the kind of investment that I believe in. But most of the men believe in that type of investment because you get quick money, and the money could be high and less as well. So, in terms of women investing, and this is why I think Intelligent Investor also says that we women, when we actually invest, we have a high IQ because we are never after a big a lump sum of profit. We're always very well balanced in terms of our expectation on how much gain you would expect from your investment, basically. And we are well balanced in not going for a very risky investment. We are always balanced with risk and the profit that it gives. And also, intelligent investor again is someone who protects or him or herself from losses by diversifying investments. When I say diversifying investments, a lot of people either put a lot of things into real estate or into stocks. That's not what we want to do. We wanted to diversify into several types of instruments so that you can actually benefit. Say, for example, when the markets fluctuate during this time, having an exposure in the bond and gold market would would stop you from selling the stocks, for example, at a cheaper price, because your investment portfolio on a whole, for example, if I take my portfolio, I don't have enough exposure probably in the real estate market, but I have exposure in most of the markets. But when all the markets are going fluctuating up and down between India, US, and UK, because of the exposure that we have, it's not going to be so bad that we have to sell everything for us to. Uh, it is not that bad that we have to sell everything at a cheaper price to survive. So that is why it is very important that you diversify your investments. And we, as coming from Asian households, gold is a de facto standard. So there is always that saving in gold, that either in a form of jewelry or ancestral hereditary or something, which will always save us from any of the downturns, because in this situation, gold is going to go up and up due to uncertainty. And also, as I said, an intelligent investor, by default, women is an intelligent investor because we never look for crazy profits, but we focus on safe and steady returns. So in terms of ISAs and types of ISAs, I think you can check the links in here, which will give you a brief overview of different types of ISAs. The ISAs that I haven't covered is also child ISA and a lifetime ISA. Because for child ISA is something that you can take on your child. Even I do that for my son Akil, who is probably 11 years old. But the only limit that we have is that we can only put 5,000 into that account, and any capital gains and dividend gains are tax free, but we can't withdraw the amount until our son turns 18. So that's the only limitation, but we can utilize all these resources to do that. So there is that is on the types of investments. Guys, if you have any questions, please do tell me um, to stop, because I can be a little bit fast for people. So just wanted to tell that if you think that you're not able to understand something, please stop me. So this is one type of investment, is in bonds. Bonds are nothing but loans that we make to the large organizations. Bond prices are worth watching in the market because it'll give you a useful direction of the interest rates and the future economic activity. When I say that a bond is nothing but is a loan that you provide to the organizations, and it'll give you a interest on that loan. So for example, there are two types of loans. I will not confuse you with too much of a detail, where you can actually buy a bond directly when it is in the primary market, and or you can actually buy a bond in the secondary market. When I say primary market, a primary market is place when the companies go with the IPO, and they actually release the bonds into the market uh, initially to all the customers around the world, saying that I need this much of loan from you, and I'm going to pay 10%. So for example, I have a bond of 1,000, and after 10 years, I'm going to pay 10% increase on each year. So it will be like once for 10 years, it will be $2,100 for every $1,000 that I invest in. I'll get $2,100 sorry, $2,000 after completion of 20 years. So that is a kind of a bond that you will buy in the primary market. There's another type of a bond that you'll buy in the secondary market. So when I'm saying secondary market is that the bond initial IPO, you missed it, and that gets listed in the market. Then you actually buy the bond afterwards. So basically, I bought the bond at 1,000 rupees, and I am expecting that it is on maturity is going to give me up principal and a 10% interest annually for each and every year. So I'm going to basically list the bond in the market, and say that due to the economic activity that I'm predicting in the next couple of years, due to uncertainty, the bond prices are going to go up because people wanted to buy more of bonds because there's uncertainty in economic activity. So my bond, which I bought for 1,000 face value, is going to trade for 1,100 as a price, for example. So you're benefiting 100 pounds on that bond by trading that in the open market. So that's about the bonds. So basically, the advantages of the bonds is that you receive the income through the interest payments, hold the bond to maturity and get all your principal back, or you can profit by reselling the bond at a higher price in the secondary markets. The disadvantages of these bonds are actually it pays lower returns than stocks, and also companies can default on your bonds. For example, there are companies which can go bust, which might mean that you may not be able to claim the amount that you paid on the bond. But bear in mind that before a company pays his stockholders, they have to pay the bondholders. They go their bondholders have more preference than the stockholders, and also bond yields will fall up and down because when you are actually selling the bonds in the open market, um, bond yields can fall when the prices are low. Say, for example, your interest rates increase. When the interest rates increase, people will buy new bonds rather than and sell old bonds, because the new bonds will have a higher interest rate than an old bond with a lesser interest rate. So bond yields will fluctuate in the term. And when I say bond yields will fluctuate if you're actually listing your bond that you bought in the market. So if you're actually holding that bond for yourself and you're not selling for 10 years, then whatever amount of face value that you've bought the bond for, at the year to maturity date, you would get that 10% annual interest. It's similar to the concept of fixed deposit saving, where you get a 10% interest rate. But in here, you're not putting your what do I call a deposit, but you're actually buying the loan of a corporate. So in terms of when you are there are two interesting factors. I don't want to go into the detail of it, but just at a headline, it's always good to know this, and you can do a little bit of detail on the Google. So bond inverted yield curves are always used by economists to predict recession and Fed to lower interest rates to minimize the recession impacts. So what happens is when the bond yield curves gets inverted, it actually says that the shorter term bonds yield more interest than the long term bonds, which is generally not the usual situation. It's very abnormal, because generally the long term with the 10-year bond should yield more than a 3-year bond, for example. So when the bonds get inverted, it means that the economy is heading towards a recession, because people around the world will not have confidence in economy in the near term. The US Federal Reserve preferred measure to gauge an inverted yield curve is the difference between a 10-year and a 3-month Treasury yield. So as I said, is basically the yield curve is going to predict the difference between a 10-year a bond and a 3-year bond. So if it sees that the yields are dropping for a 10-year bond in an inverted yield curve, it means that we are heading towards a recession. And it is quite clear that at the beginning of our year, it's already into a recession mode based on the yield curves. So it's also good. Okay, so somebody is messaging me. Just is it someone from our account? Okay, so no, sorry. So if there is anything, guys, if you want me to stop, and if there's something that you wanted to ask, please do ask, because initially when you go through this, it can give a head spin for a few minutes. But if you go through it and understand these key terminologies, it becomes very simple. So in terms of coupon rate is nothing but an interest rate. I don't know why these financial analysts come up with this, great terminologies in terms of uh, describing something very simple. But the coupon rate or a coupon payment is similar to a bond yield, is basically an interest rate that will be paid on its issue date. So if you're buying a loan with a face value of $1,000, for example, and it has got 10% interest rate, so per every year they are saying, I am going to give you $100 for every $1,000 you're investing in us, and the term loan will finish on 10 years. So by 10 years I will be getting $2,000. So basically bond yield and coupon rate are the same, and they are used interchangeably. uh, and bond yield is generally annual interest in dollars by bond par value. When I say par value or a face value, it's basically the face value of the bond. It's like a note which saying that I am actually investing $1,000, or I'm giving you a loan of $1,000 to you, and I'm going to get 10% or a 6% yield, whatever it is. Um, is the face value. So in terms of bond yield, it's always the formula for calculating bond yield is always annual interest in dollars. So $100, for example, if it is a 10% interest, $100 for a par value of 1,000, so 100 by 1,000 into 100. So bond yield on the coupon of $1,000 is 10%. And you have to also remember that when the bond yields rise, the bond prices will fall, because when we say bond yields rise, when the interest rates, for example, are rising, so people will go for new bonds and will sell off the old bonds. So the bond prices will fluctuate due to that. But if you hold the bond and you trust in the company, like treasury bonds are one classic example, or gilts is the UK government bonds. So you know that they are not going to go bust. You know they can print their money when they go bust, and you hold it till that end maturity term, like a fixed deposit maturity term. And if you do that, then you actually will get that amount that they promised on the coupon rate at the end of the term. But if you're thinking that, okay, I think it is 6% treasury yield bond that I bought in, but in the next 10 years I think inflation is going to rise and the prices are going to rise, interest rates are going to rise by 15%. So holding a treasury bond of 4% is not going to be substantially beneficial for you. So you trade that and buy a new bond which gives you 10%, 15% interest rate, um, and you hold that for 2 or 3 years until you're confident, and then sell that back again. So it's one of that kind of thing is what causes bond fluctuation. Otherwise bonds are generally, treasury or government linked bonds are generally very safe type of bonds. And again, the term yield to maturity is basically what is your yield when the bond matures, is basically an interest rate of the bond over a period of time. So that's about bonds. And while I've said, I think bond in terms of a very generic term bond, there are different types of bonds available. So I'm not going to go through all types of bonds, but these are the types of bonds where people generally invest in. So the fixed rate bonds are bonds where you know that are not going to change over a period of time and are completely safe, and it is constant throughout the life, but the interest rate or yield can be slightly lesser because it is a safer investments. Like gilts are the UK gilts bonds, and treasury bonds are like US treasury bonds, which are again constantly less riskier. And there are floating rate notes or floating rate bonds. These are the bonds that are actually linked to the current interest rates, and they are volatile in nature because they are floating, because based on your interest rate, the yield starts in a floating rate yield starts fluctuating in a floating rate, which is similar to your property market, where you actually take a loan and you do the floating rate interest or fixed rate interest. It's similar to that, but it is just that you're giving a loan to the corporation or a bank. Corporate bonds are the bonds, again, it's a debt security issued by various corporations and sold to various investors. So it's basically you're giving a debt to a corporate. So these are the type of corporate, like Tesla is one classic example where it raised corporate. So all the stocks will also raise the bonds as well, because some of the investors love investing in bonds rather than stocks, because it is more safer. So again, BlackRock corporate bond is one of the safest bond that I know, is an example of classic corporate bonds. So it's basically it's a bond, and also it's type of a fund which will invest in top 10 corporates of the world, or top 20 or top 20, 30. So you have that diversification on which corporates you will invest in. And government bonds is again another one, which is, again, I told, is the most safest type of investment, because it's linked to government. If economy goes bust, it can print its own money, so the money won't go anywhere. But in terms of interest, it's slightly less. That's gilts are UK. You have iShares, you have Hargraves, all those investment houses provide those type of bonds for UK, and you have Fed and Treasury types of bonds in US markets. And there are also inflation indexed bonds. So as I said, the bonds will have a fixed rate interest. So, but when you have inflation like 1% or 2%, some people wanted bonds to be protected against the inflation. So these are the inflated indexed bonds. Say, for example, you have the inflation of 2% on UK. So if you want your bond to pay the interest adjusted to the inflation by linking the payments to some inflation indicators, such as consumer price index or retail price index, for example, is generally the index used to monitor the inflation. So your value will be adjusted against it, and you can buy those bonds to protect you from the inflation, so that it is not a fixed price 4% or 5%. It is basically adjusted to the real inflation. So that is another type of bond people generally use. So the junk bonds or high yield bonds are our type of junk bond. They call junk bonds, but they're almost closer to stocks, in my opinion, because there's a lot of risk in buying it, but lesser riskier than the stocks, individual stocks. Example, Tesla has issued a fixed rate bond with a maturity date of March 2001. The debt rating that it received was B minus, because when it actually issued the rating, there was a chance in 2019 and 18 that the company can go bust, as you know. So this is one of the bonds which has got a very high yield rating. So basically, people who have invested in Tesla in bonds might get 15%, for example, as an annual interest, compared to a treasury bond, which might give you only 5 to 6%. But again, that has a risk on your capital loss. So in terms of rating agencies that you can use to see what bonds you have to buy, our S&P Global Ratings is one of the big three. It's the top three, I would say, and Moody's and Fitch Group. And the credit ratings are generally A and A BBB, which gives you a clear indication what is an excellent bond, what is a very good bond, very good and adequate. I also use Morningstar, which I'll explain in detail, where we can actually use that Morningstar to review the fund and see whether it is good or not. So guys, before I go into mutual funds, I just want to understand how you guys are feeling, because I'm just hello.
Yeah, good.
You guys are understanding, or
Yeah, it's good. Yeah.
Yeah, yeah.
If there are any questions, I can address in the end, or you can stop me in the middle. Yeah.
Yeah, all good so far.
Yeah.
Sure.
So they as bond is one type of investment. There's another type of investment called mutual funds. A mutual funds is nothing but an investment vehicle made up of a pool of money collected from many investors. So basically, what we are saying is a mutual fund is nothing but there are a pool of investors who will invest in a certain amount, a certain group of corporate companies. So the professional manager for the fund invests the money in different types of assets, including stocks, bonds, commodities, and even real estate to produce capital gains or the income for the fund investors. So basically, what we are doing is there are a lot of people like us who probably can't put a lot of money into it, a lot of money into one single basket, for example, because we are too scared as it'll go bonkers in either this side or that side. So in that case, what they do is this mutual fund houses take money from all of us, and they pool the money and they buy the share in these top stock companies using the fund that we are providing. Okay. So again, so an investor buys shares in the mutual fund, and these shares represent an ownership interest in the portion of the assets owned by the fund. So as I said, basically they will use this fund, they'll use this fund to buy the shares in the stock markets, but they might say that I am going to buy all the stocks of following sectors or following top companies, so top 20 companies of the world on S&P or FTSE or DAX, for example. So it's basically that type of an instrument where you can diversify your portfolio, and is widely used by many investors because you don't need to do a lot of active thinking, and it is a passive type of investment. So for the mutual funds, you generally have a net asset value, which is like total value of securities in the portfolio by total amount of shares outstanding. So for mutual open-ended mutual funds generally will have a NAV, so you can't sell or trade at any point of time, but at the end of the day it'll always calculate how many shares I do hold in my portfolio and what is the total value, and come up with a NAV index. So generally mutual funds are measured by NAV index. So you will not be buying and selling in the open market in a mutual fund from that perspective, but you can redeem your shares and somebody else in the mutual fund house will buy those shares at the net asset value per share. So basically what they're doing is they're getting all your money, they're pulling all your money and putting into some sort of distribute that into some sort of stocks, and that stock price will be calculated in terms of value based on the number of shares that you hold, and you'll say that for this fund this is my net asset value of holding in each share. That's how you calculate the NAV. So this is very important that you understand that, and also understand that mutual funds is not only in stocks. You can have mutual funds in bonds or stocks or real estate or commodities like gold. Gold ETFs, gold funds are also there, and also real estate ETFs, real estate investment trust funds are also there, which actually invest only in real estate properties. So I'll go there in detail in the next coming slides. But please keep this in mind that mutual fund doesn't mean that you're only putting in the stocks. It can be commodities or real estate or stocks or bonds or funds. Okay. So mutual fund types are generally three types. Okay. There are one, open-ended funds. Open-ended mutual funds buy back or sell their shares every day at the NAV computed that day based upon the prices of securities owned by that fund. So as I said previously, you in a mutual fund, which is an open-ended fund, you will be able to buy and sell, but only at the beginning of the day and the end of the day. You can't liquidate at every point. It's not fluctuating throughout the day. But again, you're selling that, and some other investor again buys a share in the fund. It becomes like you're actually buying a share in the fund rather than buying a share in the stock. Whereas for the closed-end funds, slightly different. They issue shares to the public only once when they are created through an IPO. These shares are then listed on a stock exchange. Investors sell their shares to another investor in the market. They cannot sell their shares back to the fund. So ETFs is a classic example where you can liquidate, because it is basically electronic traded funds are nothing but a pool of funds which are underlying value of that is actually calculated by the stock price that is going in the current market. So it's not a fund house where you actually hold all these funds and say people will only buy shares in the fund, but you're actually pooling the money and buying the money directly into the shares. The liquidation is quite faster in terms of ETF, because you're actually buying and selling at any minute at a market price. So if, say for example, I'm going bust at 11 o'clock, I can actually go and do the selling of it in an ETF at that 11 o'clock based on the current market price, whereas I can't do that in a normal mutual fund, which is an open-ended fund. So the other type of investment is the unit investment trust funds, which is issued to public ones when they are created. Investors redeem shares directly with the fund at any time or wait to redeem upon the trust termination. They do not have a professional investment manager. Their portfolio of security is locked at the creation of the UIT. So basically, what we are saying is, in this type of unit investment trust, you just only invest. It is not public listed in terms of share market. It's a fund that will be listed once, and you will invest in it, and you can only redeem the shares that you have only upon the trust termination. So they generally won't have professional investment manager, or the portfolio of security is locked, means that you can't sell and buy during the period of time. So which there are some unit investment trust funds in UK as well, but again, they are quite safer compared to open ended and closed end, but the yield won't be as high as the other two elements. So I'm generally not into that much on unit investment trust funds, but open ended funds and closed ended funds is safe enough and got better yield rates. So especially in UK, most of that is not very fluctuating in terms of investing in mutual funds. So the terms of uh, key terminology for doing a value investing in mutual funds again is basically the first thing that I'll always look at is an expense ratio. So also known as management expense ratio, it's an ongoing annual fee to keep you invested in the fund. So as you know that most of the funds might go at 5%, 6% or 7%. So if your annual expense ratio is 3% of that fund, then they're going to give you only 4% returns. So always I look for funds which are less than 1, in my opinion, uh, is the best funds in terms of provide. That's not only the measure on terms of how you choose your funds, but any expense ratio which gold rating on Morningstar and less than 1 is a good fund in terms of returns, because your expenses are below 2% of the assets. Generally, the guideline is you should only buy or funds which has expense ratio less than 2% of the total assets. So this expense ratio, as you can see in this diagram, is actually comprised of administrative fees for operating expense to keep the engine running, to pay the investment managers, and also management fees for the portfolio manager, and all the IT, that type of thing as well, and also brokerage commissions and advertising costs, because the underlying fund will also trade at the end of the day and beginning of the trade in the market. So there is also redemption fee. So when you buy and sell, they'll also take some fee, which will also constitute up to 2%. And there is also purchasing fee, funds fee for every purchase and for every sale. So you'll have to see what their breakup is when you're actually choosing a fund. So again, as I said, there are two types of funds: open-ended and closed-ended fund. And a closed-ended fund is where you can actually put it in the market and sell it anytime. So exchange-traded fund is one of that type of a fund. Is a marketable stock that tracks an index, a commodity like gold, bonds, or basket of assets like an indexed fund. So you have. I'll come to indexed fund in a while. But it's just what it is saying is it's also a fund, but it can actually track an index like gold or a bond or a basket, and you can based on the price, you can sell and buy in the open market. So investors buy mutual fund shares from the fund itself through a broker for the fund rather than from other investors. Whereas in ETFs, as I said, you buy a shell share to another participant in the market. The minimum investment in ETF is generally one share. Um, uh, Generally, the funds will have 1,000 to 5,000 as a minimum investment, but this has changed over a period of time drastically. Like Vanguard and all, you can put $200 or $300 as well. But generally, when you pay in SIP, I would probably say put a bucket of 500 or $1,000, because the more buys and sells you do, the more price that you would give to the brokers rather than putting that profit into your pocket. So even in SIP for every month, like I would probably do a 400 or 500, that type of thing, based on how, your risk appetite on there. So again, prices fluctuate during the trading day for ETFs, but whereas NAV, it doesn't. So for example, gold ETF is a classic example, which you can use. And the gold ETF means that you won't physically own any gold, but you can. Uh, it is actually an investment in gold index. So basically, based on the fluctuation, say for example, your gold is £5 today, and tomorrow it's £10. You make a profit of £5. Your ETF will also make a profit of £5. So it's basically a share that you can that you can sell based on the index. So gold ETFs provide investors with a low cost, diversified alternative that invests in gold backed assets rather than physical commodity. But, in a physical commodity, most of the times you would probably be scared of holding a lot of gold, and people can come and steal from us. And also, there is also a locker cost that we need to incur if we have a lot of physical gold bars, for example. So for those people who are not interested in gold jewelry and wanted to invest in gold only in terms of an investment, gold ETFs is one of the tool you can use to purchase and sell gold at a current market price. So if somebody is bought a gold 10 years back, and now if you see the price, they would have made that many times, and it's generally is almost equivalent to the prices that you make in property. Is quite stable, but it is not, it doesn't pay, unlike properties, it doesn't pay you any dividends or rentals, for example, on your property. But it's also one type of other investment that you can use. Whereas there is another type of bullion vault is not an ETF, but it's basically, it allows you to buy a gold bullion and own it directly as a personal property, storing it in one or more of choice of high security accredited vaults situated around the world, and be able to be traded 24 by 7 online or through IOs or Android apps. So what they are saying is you don't need to put the gold in your locker. They will have a bullion vaults where a lot of investors will purchase physical gold, and all of them will share that bullion vault cost. So if you have to purchase your own private locker, it's going to be pretty costly. But when you are, and also you need to be worried about security, etc. But these bullion vaults are secured. It's electronic, and you have anytime you want to sell and buy, you can sell and buy in the market. And you are buying the golden bars, and it'll be stored in your bullion vaults. After 10 years, if your kids are going for a marriage, for example, and you want to redeem, and you want to present the gold bar to your daughter-in-law or son-in-law, whoever it is, you can actually redeem that and get that delivered to your address, and give that bullion vault to your family members. So in terms of there are gold derivatives, gold futures. I'm not going into futures and options and derivatives, because that's quite a complicated market, and it might need a second session after you understand the basics of it. And I always stay away from that type of things which are very fluctuating, though it is very what do I call it is very attractive because the yields are very high. Okay, so there are gold ETFs is one. There are two types of ETFs. So one, it can actually track the index, and it can actually uh, give you a profit or loss based on the index price. There's also another kind of gold ETFs, which are gold mining in ETFs. So basically, what these ETFs will do is it'll actually invest in gold mining companies. So based on how the demand is for gold, it can go up and down. But I'll always stay clear away from the mining companies because you need a lot of experience in choosing the right mining companies and choosing the investment in the right mining companies, because mining is a big market which requires study and the detailed analysis of which mining companies and which countries you can put in to get the maximizing profits. But still, I've given you just to have a rounded view of gold ETFs that you can use and what are the advantages and disadvantages, which I've actually covered on this slide. Here comes the index versus mutual funds. Again, this is another types of mutual fund. And this is a mutual fund generally that I really love, because this doesn't require us to do any type of monitoring the markets. You can put that in the indexed fund and it'll track the FTSE 100 or S&P or Sensex or DAX 30, which is a European market. And your funds will increase according to the market index. So if index will increase by 7%, your indexed funds generally increase by 7% as well, which is quite consistent over a period of time. You take on a 10 years period of time, it's always 7%, 8% returns. I don't need to do anything. It'll track the index funds. And I know my investment is safe. It's slightly higher than Treasury. It's slightly higher than ISA, a savings account, and there's no risk to the capital gain. Okay, so that's the one of the type of funds, again, which is quite risk free from my perspective. A gold bond and index are any day risk free type of investments. Mutual funds I'm not going to cover in this slide because I've already covered what mutual funds are. Again, uh, as I said, the index funds are low cost. You don't need to. Most of the mutual funds will have a cost above one, but index fund expense ratio generally is less than 0.10, because you don't need to pay the costs for all these financial investment bankers to choose the right funds for you. It'll automatically track using a robot or using your IT workflow tools, and invest in the funds which are top 50, for example, in FTSE and top 50 in S&P. And hence, I always believe on a long run, it's not just my belief. Even Warren Buffett has said, and also won a $1 million bet on some of the top investment bankers in the world, who said that they will beat the index in a 10-year period, and they were unable to. But the indexed fund is the only one which won, because it doesn't need any high high IQ investment managers to work on the funds, who are also prone to making bad emotional judgments. Rather than that, index funds use system to actually invest in the topmost indexes. So some of the index funds that I own are Vanguard S&P and Vanguard uh, DAX, for example, 30. DAX 30 is a German market, and I have some of the FTSE shares, so I never purchased the FTSE indexed funds. So it's again, that's about the indexed funds and mutual funds. So here comes another real estate investment trust fund. Is and real estate investment trust is, again, it's like a unit trust where you invest in the trust, and you'll only be able to you'll be able to sell that in this type of trust. Unlike unit trust investment funds that I've shown before, you will be able to sell the price on the open market, and buy the price shares from the open market. So in terms of a real estate investment trust, is a company that owns, operates, or finances income producing real estate regulated by the government. This is completely regulated by the government, and it is also something that owns and operates a finance income producing real estate. So what I mean by that is, it only uses to money to buy managed real estate like malls, office spaces, warehouses, hotels, and apartments. And it also has a regenerated growth based on the property pricing based on property price increases and also rental increases, and it pays 90% of the profits by dividends. So a real estate investment trust are kind of a trust where the investors pool and buy the real estate. For example, there are a real estate fund called Land Registry and British Land, which has got a lot of exposure to a lot of commercial properties, residential properties, office spaces, and also retail spaces across London and across UK. So these guys actually use that money that we are purchasing the shares for and invest that into the real estate. So the key terminologies that we need to use for investing in REITs is dividend payout ratio, and the funds from operations is generally the two terminologies or two key terms that we use to value a real estate investment trust fund. So at the minute, with what's going on in the market and the Brexit, I don't know how much REITs is going to give us the future value. But again, it is a good value investment if you're looking for a long term, like 10 years or something. So for the last 2 3 years, because of Brexit, all the REITs have fallen down, and it's trading at a very pathetic share price from my perspective, and could be a good buy-in if you're actually looking for a 20 years long-term vision. So one of the two things that I would always look is the dividend payout ratio. So the dividend payout ratio is the ratio of the total amount of dividends payout to shareholders relative to the net income. So out of total income, how much the for example, a dividend payout of ratio of 90 is that the company has actually paid 90% of this net income into dividend as a dividend. So basically, it says that if you're looking at a dividend paying REITs, then you should go for that. But generally, some of the companies may not pay all the net income as a dividend because they might be investing that into other real estate properties, other commercial properties to grow business in the long term. So in that case, you'll also have to use funds from operations. Is used by REITs to define the it's a ratio. If you go into Hargraves, if you go into any of these tools that I'm going to tell you, it'll tell you what is the FFO for each rate, and you can use that to evaluate whether you want to go for it or not. It just defines the cash flow of the operations. It's calculated by adding the depreciation and amortization um, to earnings and then subtracting any gains on sales. So basically what it is net income. As you know, the assets will also go with depreciation and amortization. So you're uh, adding that depreciation and amortization to the net income, and also subtracting the gains of sales on the property. So it'll give you over a period of time what is your real income. So it's basically nothing but real earning per share of what you held in REITs. So simply take a dividend per share and divide by FFO per share. So if you're actually looking for a simple formula, so I would divide a dividend by an FFO, which will give me what is the yield of that rate. So if I'm putting 100, for example, if I'm getting a 5% as a yield on British Land, I might actually go for British Land instead of Land Registry, which might have a 4% yield, for example, after I've done the dividend payout ratio by funds from operations. So funds from operations, what it'll do is nullify the impact of some companies using dividend to grow in the next few years. So that's why you use generally these two terminologies to evaluate the value of the REIT that you're doing. So there are 5 types of REITs. So retail REITs are the properties where you invest in retail properties. Residential REITs are actually REITs which actually buy only residential properties. Similarly for healthcare and office and mortgage. So before I go, this is the last slide I have. Before I go, I think I'm just overrunning. Do you guys have 10 minutes? It's the last slide. I promise it'll be fast. I'll finish it fast. So, okay. So, again, this is key terminologies for value investing. So if you're looking for value investing in stocks, these are the kind of ratios that I'll use to evaluate the stocks. So the first one would be a quality rating, either from Morningstar or some other um, some other quality ratings like S&P or Fitch or something on the credit rating of the company when I'm actually investing in the stock. The second criteria is the debt to current asset ratio. Basically, what it says is how much debt that a company has got to current asset. Generally, recommended practice is less than one, because you should be investing in companies which has got less depth compared to the assets that it holds. But however, it also depends on different sectors and different industries that you are on. So basically, for example, there are a lot of capital intensive sectors like energy sector, utility sector. They require a lot of debt to expand the company. So you have to always compare these ratios against the different companies in the same sector. For example, if I'm using National Grid, I would compare that National Grid with Eon or Centrica to see what is their total debt to asset ratio in terms of choosing the stock. Again, the current ratio is generally best practice is to find companies with ratios over 1.50. Basically, what we are saying is current assets are 1.5 times current liabilities. So there are a lot of tools which give you that information. You don't need to calculate that by yourself. There are tools where you can put the stock ticker and it'll give you that information. So it's again, you have to find companies which has PE of 15. It's price per earnings. So basically, for you to find out if the price is right, for example, you need to understand how much price you're paying to earnings. So generally, if a price ratio of 15 suggests that you're paying 15 times price for the earnings, is generally a good standard to invest in companies. Any PEs with more than 30, 40, Benjamin Graham actually says stay away from it because it's not value investment. And PE gets very, very less during this downturn like COVID-19. So the same thing for, there is difference between the price to earnings per share and price to earnings growth, because some of the companies might actually, again, price to earnings would only give you an indication of current price to earnings. It doesn't take into account the future growth or future earning potential of the company. But whereas the price to earning growth ratio will take the growth factor also into account. So you divide the PE by the future earnings forecast or earning growth forecast. So, for example, a company is going by 12% or 30%, and 15 by 30 would be your ratio. So it will give you a peg ratio of anything less than a 1 is considered better, whereas anything higher than 1 is considered unfavorable, because it's saying that you're paying more price than the earnings of the company. So it's criteria 7 again is price to book value, which is another ratio. So a company book value is the value that the markets will pay if it actually goes bust. So if you're finding companies with price to book values with less than 1.20, it's generally a very good price to pay, because you're almost getting a share which is equal to book value, which means that if company goes bust, you're guaranteed to get your share back. In terms of value criteria 8, you'll always have to look for companies which had higher paying dividends consistently, like for example British American Tobacco or Shell or utilities company which has got consistent dividend paying history for 10-15 years, for example, which shows that the company is in a growth trajectory. Some of the large organizations with large market capitalization will grow consistently with a consistent dividend, but may not have like 100% gains in the next 1 year. Whereas when you actually go for a small cap type of company, you would probably have more gains, but more risk to your capital investment. So this is again, I don't want to take a lot of your time in explaining this formula. You can use this formula to calculate a Graham number. Is basically what it says is you use a formula to calculate a number based on the book value and earnings per share. And if your say for example, after you put the number, you got a value. So 1837, for example, is the maximum an investor should pay for a share of ABC if the share is priced at 1.50. So if a single share of the company is 1.50, and the Graham number after you derive this formula is 18.37, so the maximum amount of value that you have to pay for this company with a current share price of 1.50 is $18. Okay, if it is priced at 19, then it should be avoided. So some of the um, shares that you pay might be premium because it is more famous in the market. So this number will help you to do value investing in stocks, and you compare always these ratios with other big companies in the same sector to understand the industry average, because these are just the numbers. It's best principle, it's absolute gold standard in terms of going stocks, but there might be many stocks people would have bought with probably not the same ratios, because they would have compared that with another stock in another industry. So in terms of the tools that you can use, I think I put in a lot of tools that you could use to do this analysis, but I will show you some of my favorites where I've used that tool to do my fundamental analysis. So one of the tool is this, which helps me to understand, for example, and the Morningstar. Uh, so it's okay. So I'm going to do my favorite British American Tobacco. BTI is the ticker, I think. Okay. Okay. So this is one of the tool I find it very useful to understand the ratios. For example, debt to equity ratio 0.71 means that I can finance 71% of my debt. I mean, what I meant was 71% of equity is in debt, for example. It's basically debt to equity ratio. So basically, it's saying that I can finance 71% of the debt with my equity. So you have quick ratio, current ratio, for example. So you can actually P ratio, as you can see, the PE ratio is currently at 12.59, which means that the British American Tobacco is a good buy and it's got a good dividend ratio. And also you can see price to book ratio is it's like a gold standard because of the current market downturn. So you can use this and use my value criteria to choose the right stocks. And also you can see the dividend yield on the BAT is 6%. So basically, if you're investing right now, so annual yield on the amount that you're putting is 6%. So if you're putting, for example, 1,000, then you get 60 pounds as a dividend. Yeah. And again, this is something, the red doesn't mean really red. It's just showing what the current market is versus history. So you can use this information and these ratios to understand a little bit. And also, I think it'll also, if you go into there, it'll tell you what it is. And you can find out more about what exactly it is. I know that I've told you um, uh, uh, the ratios in today's call, but it might be a little bit overflowing when you hear for the first time, but you can do your analysis. And this is a pretty good tool, which gives you an overview. And also the PEG ratio, as I've said, is 0.97, which is below 11, for example. So same thing with if you actually look at Shell is also trading at the same PE price and a PEG ratio, which is unbelievably low because of the current market uncertainty. So people, if you're looking for a long-term growth, you would probably be investing in looking at the fundamentals rather than about current uncertainty. And also make sure that you only invest a portion of your investments into it. And also this is also a very good ratio, generally recommended Schiller PE ratio, which is actually a PE ratio, which is calculated not for every year, but it's calculated for the last 15 years. Anything below less than 10 on a Schiller PE ratio is a very good company to invest. So at the minute, the British American Tobacco, as you can see, is actually trading at a value which is probably less than its company fundamentals and the balance sheet that it has got. So similarly, you can take another company, and like I'll show you Halma, which is another one as well. So you can see that. Okay. So I think they're not showing me because obviously I have to log into the number, but it'll give you the same thing. You can see that the PE ratio in here, for example, is 47 times the price. So it is absolutely overpriced compared to the earnings till date. So that's kind of thing that you do on there on the stocks. On the I generally do the Vanguard, which is for the funds. Yeah, just give me 1 second. It's also one of the thing you can, once I show you this, you can also use the Morningstar to uh, review of funds and make sure that you investment in the right fund using a gold star rating of Morningstar. But also you can use Vanguard, for example. It has got a lot of funds, as you can see. Just generally uh, very good ones that I really love, because it gives you here a very transparent breakdown of what is the fund and what's the breakdown, and it'll give you the graphs as well. So if you go into the view performance, for example, it'll tell you how it has actually increased over a period of time, and you can make your own judgment based on that. For example, any indexed funds in these funds will be less riskier because, as I said, you have a lot of funds and it'll give you a performance view when you actually go into that. But indexed funds in general are totally linked to index. So I think I'm already overrun 15 minutes. So I know that some of you wanted to go and it's a Friday. So if you wanted to ask me any questions, I could. And Vanguard also has SIPP, which you can use to invest into your pension account and on a long term. Yeah. Guys, you can ask questions for me. Sorry.
I'm going to jump in. I've got a question. Yeah, thank you for all of that. You talk about it amazingly fluently, which is fabulous. I think that not enough women are interested in investing and finance. I think, yeah, clearly traditionally it's not really being seen as part of our sphere of interest, and I think that it should be. So how did you get into it? How did you get interested?
That's an interesting story. It's basically because of my husband, who was a commerce graduate and who was challenging me that I know nothing about anything other than SAP. So that's how I've learned accounting principles, and that's how I learned on the job on the financial investment principles as well. And now I know more than them. So he shuts his mouth now.
That's always
So
good.
that's
A bit of competition always helps, doesn't it?
Absolutely. When he was investing, I had lots of questions, lots of challenges, and he was making fun of me that you don't know anything other than SAP, and that's what triggered me. And now, when I've read those books and accounting principles and understood how the economy works, I always felt on why I haven't done this in my college. I always felt this is a boring subject. It always gave me a head spin when I was in college, but I really enjoyed it when I was reading it in 35. But if I read this, Rebecca, 10 years back, I'm telling you, I would have bought Keytray. You know, it's just
it's not a particularly. I've dipped in and out of it on and off over the years, but I'd say I don't find it a particularly friendly area. There's so much jargon in there.
Yes, absolutely.
So yeah, you have to immerse yourself in it a bit to understand some stuff. But I think that there's some bits around the edges that you can understand the ideas of and get involved with without it being yeah, maybe less technical.
Yes, that is correct. So there are. I think my husband is an active investor. I call myself as a passive investor. I know that we need to put a lot of effort in terms of evaluating this, and also know a lot of ratios to evaluate a stock and see that it is the right price, and also evaluate the balance sheets. And sometimes the balance sheets can be cooked up as well. And especially in emerging markets where there are more returns, they're more cooked up the balance sheets are. So I always stick to this Vanguard, Rebecca, as I said, is basically indexed fund where you are not worried about it, and it generally gives you. I mean, even in this market, it was. I've invested in last 3 months. But when the market cracked up in March, it was down by 30%, whereas stocks have gone down by 60%. But when the market is up, it was around 15% right now in terms of regain. So basically, my portfolio of investments on Akhil Share ISA was like 15%.
So I have to. I last week, Monday maybe. I've written a short thing about women and pensions, deliberately keeping clear of your stuff on investment strategies. But I don't know if anyone's clocked the value of what's happened to their pension in the last few months. It's taken a proper good nosediving. So we can all look forward to that, hopefully regaining its strength before we need it. But this is kind of real stuff, I think, that impacts on everybody. So
yes, arguably, if you ask a woman whether you've done an investment in the last 3 months, they'll say no. But if you ask any of our directors, they would have put some 20% of the money into it. And I mean, I obviously, because I'm social, I keep asking what investments they're making and what they're doing, how much they made, etc., etc. So most of the directors have actually put some money when it has nosedived and had reaped the benefits, because it was classic example, Rebecca. The markets have nosedived by 20-30% by default in every stock. And if people have bought it, they made that price. And even index funds, as I said, when I saw my portfolio back in March, it was around minus 25%. And now it was plus 15%. So with the funds, I have seen that it actually fluctuates only between those. So the maximum probably you would lose even in uncertain time is maybe 30-40%, not more than that. But again, 30-40% profit. It's not like 100 or 200% profit. So that's the difference. And in the pension, glad that you spoke about it. I haven't gone through the detail on the SIP, systematic investment pension plan. And I know that we do a KITRI employee pension plan, which actually puts that into a pension fund, and we make investments even in the pension Aon. I've used 3 indexed funds and put all my pensions into the indexed funds on the one in emerging markets, one in US and one in UK. But there is also SIPP, which Vanguard offers, which is your investment that you can make. You get a 40% tax rebate, I think, from the government on that. And the beauty is that you can actually invest in long term, either in stocks or indexed funds like Vanguard or something. And like, for example, life strategy funds in Vanguard, these are target retirement fund 2020 2025, so they balance it out. So they're saying 60% equity, 40% bonds. So based on when you're retiring, you can actually directly invest in that. So these funds are very low cost.
And I think that's one of the pluses now is that you can invest in stuff
yes
without being an expert, because there's some kind of fairly common sense stuff that you can look at it and go, oh, okay, yeah, I can see why it would be a good idea to do it like that. So it's more accessible.
Absolutely. So the Vanguard personal pension has been launched this year, and it is the pension plan with the lowest incurring charges. Hargreaves was the one before. But again, there is nothing like SIPP and Vanguard, according to Buffett as well, because there are no shareholders in Vanguard. The shareholders are the investors themselves. So there is no big shots investing in Vanguard. It's all our people who are like middle class, upper middle class, who's investing in what Vanguard are their shareholders. So compared to other investment fund houses, that's why Warren Buffett says this is much better. It's actually US-based fund house, which recently launched that plans in UK. And the Vanguard personal pension plan is basically you can put up to 40,000 per person, I think, and you get a tax rebate on that 40% tax rebate, and also government adds something on top of it. But you can't withdraw any amount or capital gains until you are 55. So you would probably put it in like some amount in there with a long-term view rather than a short-term view. So I think
anyway, I have to go.
Yeah.
So I'm going to have to scoot away. I don't know if anyone else has got any more questions, but thanks so much, Shravya. That was you clearly spent some time putting that together.
Yes.
That was great.
Thank you, Rebecca. Thank you for your kind words, guys.
Guys,
Anybody else has got? Yeah. Anybody else has got any questions?
I just wanted to just join up from what Rebecca was saying there. With the pension, I can't remember if you are allowed to have a company pension and then an external personal pension, or if you're not allowed. I don't know whether you know.
You're definitely allowed. Okay, is my voice clear?
Yeah. Can you?
Okay, Melissa, you're definitely allowed to have a company pension, and you're also definitely allowed to have a SIPP. SIPP is on top of company pension. So basically, it'll also give you tax benefit, because if you're, I don't know, just making an assumption, because we are an IT company, generally we at a higher tax bracket, like 30-40% of our income is taxed. So with SIPP, you can reduce that tax bracket for the amount of money that you put in into SIPP. So it's also an additional benefit if you're looking for a long-term investment and also to get some tax relief. It's actually a good pot that you want to put in, but only limitation that we have on the SIPP is that you can't withdraw that money before 55 years. So it's for your kids, I would probably say.
Oh no, I'm quite close to 55.
Oh my! Oh, okay, sorry, I didn't realize.
No, that's all right.
Then it's a very good thing, because 40,000 per year is the limit, and you can buy into index funds and put that amount in, and you get the tax break as well.
Yeah, that's good advice. Thank you.
Yeah, absolutely. Anybody has got any other questions, guys? Otherwise, I'll round up. I think I talked a bit more than I expected.
No questions for me at the moment, Shravya. I just want to say thanks. It was definitely a good refresher, and still need to wrap my head around it more. And then maybe I'll come back to you.
Yeah, if you need any clarifications, please come back. Guys, if none of you have any questions, then I'm going to disconnect the call, and maybe I'll send the recording to you guys so that you can actually play it and hear it as and when you want to clarify or to understand the subject even more. If you want me to say something, please do let me know if you want me to clarify or say something.
Yeah, it was a great session, Shravya. Thanks for that.
Okay, guys, I'm just disconnecting it right now. Thank you so much for your time and for making it.
Thank you.
Thank you.
Have a nice weekend.
Thank you.
Bye.
Bye.